Hi everyone, welcome to another edition of Investing. This is probably the 20th or so lesson. It's September 11th, 2016. Very ominous day in history, but let's focus on investing. So I spent a good part of the last lesson explaining why people shouldn't try to invest and why I think it's a zero-sum game in general, and it's very difficult to make investments that make money, and that a conservative or no investing philosophy is the best philosophy for the average person. I tried to debunk the myth that U.S. equities grow over the long run. I hope I was convincing. I think that the risks you take to correctly gain any alpha that you think U.S. stocks offer you is probably way too much risk for the return. So I think that the average person should not try to invest. Despite that, I'm doing this lesson series, and it's kind of geared to people who want to be investors for whatever reason. Now, keep in mind, even though I think the average person shouldn't invest, I do think it's possible to make money investing. It's just very difficult. And this lesson series is kind of directed to people who want to be professional investors. And what I mean by that is people who are willing to dedicate their entire career, their entire life, their entire focus to investing, which is very different from what the average person is willing to do. Even if you do that, there is no guarantee you will be a successful investor, which I think is another thing that kind of trips people up, that you can do something, and I've seen dozens of people, hundreds of people, probably thousands of people that spend their whole lives, 20, 30 years, trying to be professional investors and not being very good at it. So I'm going to try to impart some of the things that have made me a successful, what I think is a successful investor, but and also some of the mistakes I made along the way that will also be helpful. So as usual, we sort of try to keep it light at the beginning, and I'll give you a little bit of an agenda. What I want to do is talk a little bit about hedge funds in general, because I know that's a sort of a topic a lot of people are interested in, and then I'm going to focus on one hedge fund, or in today's case, a group of hedge funds called the Tiger hedge funds, and then I'm going to move over to focusing on software stocks, which we kind of took a break from many months ago. I'm actually going to go over a stock that we all went through called Angie's List. I actually have all of the models that people contributed last time. It's about 10, 15 models, and I'll go through those as quickly as I can, and then we're going to look at a new company, and maybe we'll even choose together which company to look at. So, without further ado, I thought I'd make a list of hedge funds. This is a very small list. This is not an even remotely complete list. There are thousands of hedge funds. There's about 20 some odd hedge funds on this list. And what I thought I'd do is kind of show you some facts and figures and show you where you can kind of pull these up. So the first place to pull up filings like this is the SEC.gov. So SEC.gov is a great website for corporate filings. It actually also works for hedge fund filings and mutual fund filings. So what I did here is I typed in Bridgewater, which we looked at last lesson. It's the largest hedge fund in the world, at least that's formally organized as a hedge fund, which means its own thing since it's just a limited partnership. But you can see when you type in Bridgewater, a lot of stuff pops up, but in general, you're looking for the advisory company, and Bridgewater Advisors is the legal entity that that used to file these filings, but there's other ones. So Bridgewater Associates, I think, is the one that does it now. Bridgewater Associates LP, this is a limited partnership. And you can see here by the filing dates that they make these regular 13F HR filings. These are holding filings. This is rules 13 subsection F, and it's a holdings filing. Now, I don't advocate looking at these filings. So you might ask yourself, why are we making a list of them and so forth? And I'll explain that in a minute. And a lot of it is related to people who want careers in this industry. But I definitely don't advise you looking at these sorts of filings and trying to divine anything, any wise investment ideas from them or anything like that. I would avoid that virtually at all costs. But having said that, we should take a look at what these things look like. So here you see this regular 13F filing. Every quarter, Bridgewater, for the last many, many years, seems to have filed this 13F filing, and I actually bookmarked that here, so you can just find this list very easily. And you can see it goes all the way back to 2008, even further back to 2006, so 10 years of quarterly filings. So if you open up one of them, you see that the filing is actually 4 or 5 different files. So I open up the first one, and what's kind of cool about this is you get a phone number, you get an address, you get some contact names. Most importantly, you get the value of the positions and the number of positions. So I wrote in this that they have $8 billion of positions. Now, you might say, hold on a second, doesn't Bridgewater have $150 billion of investments? They do. They have $150 billion of their client money, but they only have $8 billion or so on this 13F. Well, why is that? Well, the 13F rule applies only to equities, and it applies only to, or equity-like instruments, so it doesn't apply to, say, debt. It applies to convertible debt, but it doesn't apply to regular debt. And it only applies to U.S. equities, and it does not apply to short positions. So virtually it's only long U.S. equity short positions, and there's even further rules that drill it down. So you're going to find that funds often have more assets than they do, than they're reporting on the 13F at least. I'm going to go through the form ADV, which is another form which you might want to look at. So anyway, I wrote down $8 billion here in equity positions. We know that Bridgewater is a macro fund. They don't really have equity investments. They probably make equity investments as a very small part of their business, which it makes sense. It looks like it's only a few percentage points of their assets. Now, if you actually click the wrong one here, if you click this HTML, you'll actually see every single equity position. Now, you might say, oh, why do people pay hedge funds so much money when you can look up their equity positions? Well, at the end of the day, these equity positions probably change quite often, and furthermore, this is only a small snapshot of what the fund is doing. So it's very difficult to get the entire snapshot. Now, there are companies where you can occasionally divine their investments, but in general, these are not very valuable pieces of information. So why am I showing you this? Quickly before we answer that question, let's look at this form ADV. Now you can go to a website called the IAPD. Here's the URL for that. It's you can just Google IAPD, it'll be the first thing that pops up. And you can actually read something called the form ADV. And this has even more interesting information where it says the number of employees. In this case, 1,500 people work at Bridgewater. You might wonder what kind of operation has the biggest hedge fund in the world, what kind of operation that is. It's 1,500 people. You see some contact information. And interestingly, you see this definition of assets. In this case, it says that they have $212 billion of assets, and that's probably about double or 50% more than what they actually have. And the definition of assets under management is a very difficult and tricky sometimes definition. And you can see here that there's an instruction on how to calculate regulatory assets under management. You must follow these instructions very carefully when completing this item. So anyway, you can kind of do that for every hedge fund, and just looking at a couple of hedge funds here, we can see, really just 5 or 6 hedge funds. We have $500 billion just amongst 5 hedge funds that I picked from, which is really kind of telling of how big this industry has become, and probably why I think there's very little opportunity for hedge funds to make money. In fact, many hedge funds are struggling and have been struggling for many years. So why do we pull up this information? Well, I think that it makes sense to not sort of look at hedge funds that you think are good hedge funds or bad hedge funds and try to bet on them or against them. I think what makes more sense is to try to find trends in the system. And so what I mean by that is if you can go back and track the amount of hedge funds and how much assets they have, and you can kind of get a picture of where the money is going, so to speak. And right now there's a lot of money managing equities. So you have a lot of competitors that are trying to find cheap stocks, just like you. And I think that makes it very difficult to find a cheap stock if everyone else is looking for the same cheap stock. The number of people doing private equity, if you actually do that math, has not changed very much, and the number of people doing venture capital has also not changed very much. So it turns out that I think the higher returns are in those areas. Number of people starting companies is also an interesting phenomenon, especially in more staid industries. So we can talk all about that later, but I think that you can sort of get some clues, not on specific stocks per se, when you look at filings like these, but just kind of where the world is going. And it also helps, like if you wanted to work at one of these places, to know a little bit more about the firm and to get more familiar with kind of what your role could be at one of these places. So, with that being said, I think it makes sense to turn to a group of hedge funds that I know I followed over the years called the Tiger hedge funds. And we profile probably about 5 different hedge funds so far, and it makes sense that this would be the next hedge fund to look at. We're going to answer some actual investing questions shortly. But again, I think that knowledge of some history with respect to hedge funds helps with respect to trying to, like I said, ascertain where the opportunities are in the future. Certainly equities is a tough sell, if you ask me, with respect to generating good returns in the US right now. At the moment, I think hedge funds are more focused on total fees rather than performance annually, which makes a lot of sense. I mean, fees are how you get paid. So to the extent a hedge fund would rather earn 10% on 10 billion than 20% or 30% on 100 million, that makes a ton of sense. And so not taking risks, not taking headline risk, especially investing in things that could result in investors to withdraw, those are the kind of actions that hedge funds are taking now more than maybe before, taking risks like leverage and stuff like that. So we profiled Renaissance, we looked at an old fund called Steinhardt, we looked at a fund called Bridgewater, and today we'll look at a fund called Tiger. And I might have talked about this fund once or twice. It was started by a fellow named Julian Robertson here in New York City. It was started a long time ago, and I think Julian Robertson is very self-deprecating about his age. He likes to joke, I think, that he's an old goat. Last time I saw him, he said something to that effect, and that all these young folks manage his money, and that's sort of been the nature of it for a long time. Tiger, the original hedge fund, closed in 1998. I think I have this channel open. Let me just mute that real quick. And it was interesting because the fund had fantastic performance for a very long time. And then ultimately, in 1998, or maybe it was 2000, I forget, there was some poor performance from the fund, and they decided to close the fund down. Now, interestingly, Robertson didn't close all of his investing activities. He actually helped start some new hedge funds, and now we have we have the original Tiger fund, new fund called Tiger Global, or Tiger Technology was the original name, and it became Tiger Global. That's run by a fellow named Chase Coleman. And then finally, a lot of the Tiger employees started so-called Tiger Cubs. And so what happened is those Tiger employees said, well, even though Tiger's shut down, maybe we can start our own hedge funds. And probably the 3 most well-known are Maverick, Lone Pine, and Viking. And all 3 funds have had these relatively good returns. I'd say Lone Pine has had tremendously amazing returns. The fellow who runs Lone Pine is named Steve Mandel. And Tiger, it's sort of amazing to people that all of the Tiger employees seem to have these really successful, all the folks that came out of Tiger had really successful track records. And I think that speaks to this concept in hedge funds that pedigree has always been, but is an important predictor of success. And this is why I like to talk about investing like a craft, because I really do think it's a craft. Put all the new information in red, so when you guys download it, you'll see what I added. I kind of think of it as like an art form or a craft that's handed down. It can't really be taught. It's sort of like surgery or blacksmithing or something like that, where you actually have to hand learn it from somebody. So I actually worked very, very briefly for a so-called Tiger Cub called Intrepid, which is still around, but I only was there for about a year. But I do think that it's interesting that passing down this sort of important tools of the trade, so to speak, or ways of thinking, seems to have been a pretty important predictor of success. Not always, though, and it's important to sort of think that through. So Tiger didn't have, I think, overwhelming style. I mean, you could say that it was a value-focused, sort of equities-focused fund, but it also did macro. And it was sort of an interesting fund in the sense that Julian was the sole so-called trigger puller. He was the one person at the fund who actually could execute the fund's orders. And again, with so much talent at Tiger, it was really a huge fund at a time when hedge funds didn't have money assets. Tiger boasted, I think, 10, 15, or $20 billion of assets. So in the 90s, there really only were a few very, very large hedge funds. It was sort of Tiger and Soros were more or less the two largest. So anyway, if you want to learn more about Tiger, there's a lot that's been written about it. Tiger is still a very important force in the hedge fund world today. It's also a place that tends to hire younger folks, so it's definitely a good place to make your home. It's like all other parts of the hedge fund world, it's very competitive and difficult. But I just thought I'd mention the fund here. I won't go into it in too much depth. Only took 5 minutes. So, a long time ago, I made a list of a tech, so to speak, technology spreadsheet with a list of companies. And I have this hypothesis that it's very difficult to determine what outliers are in a list of companies. Let's take a look at this list. I generated this list with Bloomberg. There are, I asked them to show me all software companies above a 100 million market cap. And there are, 528 of them. And if you graph this according to a normal distribution, in fact, let me do that right now. Let me do something kind of tricky here. This will be fun. Let me repeat this screen, except I want to add something kind of neat to it. And I think you'll like this, and I think it'll hopefully get you to think a little bit the way I think about this, which is I try to be as systematic as possible. I don't want to take things for using adages or guesswork. Let's see, 25, let's see, 2015, last year. Trying to find this will be kind of a neat once I find it. Price change 1 year net. Yeah, I think that'll do. Oh, this is good. All right, so there's 828 software companies above 100 million. I think I used a different parameter there, but that's fine. I'll take with the more rather than less. All right, so I'm going to output this to Excel. I'll close this guy. Let's see. Where is my? There it is. Cool. So here's all the software companies in the world. Let's see here. And the year-to-date return for all of these companies. There's 828 software companies, so to speak. I don't know that they're all software companies. But if I sort them by performance, this is ultimately what your job is, in my opinion, as an investor. If you're, say, a software analyst, your job is to look for these successful investments and be long those successful investments and be short the unsuccessful ones. And you can see this is a really cool, I think, graph of actual return for each of these stocks. Now some of these stocks, this is like a 100 million market cap. We can exclude some of them. Let's say we exclude these two. Yeah, that's a little better. So you can see the number. Let me just get rid of these Japanese small caps. I don't know that we need to look at anything that's gone up this much. Yeah, okay. Here we go. This is a better list. Exclude a couple outliers. All right, so the average, I'm going to do an average that excludes the top and bottom, say 20%. And you see the average software stock is up 5% over the last year, which is sort of probably within the bounds of where the market is. But you can see that, and if you invested in the software sector, you might expect 5% average returns. But you can also see that there are you can see that there are 80 stocks that are above 50% year over year price change. 80 stocks. Now some of them are pretty small companies. So if you want to look at this list with only say $1 billion companies or so forth, you will have a smaller list. But regardless, there are outliers. This company WB, Weibo Corp. There's this company Interactive, Shutterstock, and Wix.com. These are 4 really big outliers. Here's another one called Ebix. Here's another one called Gigamon, Cena, Ellie Mae, I don't know that company, Alarm.com, which we've looked at before, Symantec, which is a very large company, Travel Sky, Jasmine, and a handful of others. And so here are, I don't know, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, I don't know, 15 outliers that are software stocks that have done really well. And you can see that you're trying to capture these outliers, right? There are maybe 100 software stocks that had really good performance over the last year. And you can see the ones below zero are the ones that have really poor performance. Let me go down to those. Let's see what they look like. Here's a bunch that are excludable. Let's see here. Some of them are in China. Many of them are in China. Tableau Software, Samsung SDS. I don't know which is some division of Samsung, I suppose. AutoHome. A good FireEye. There's a good handful of these that have dropped somewhat dramatically. And again, if we want to exclude Chinese stocks, we can exclude those. If we want to exclude some by market cap, there's so many from China. It's sort of remarkable. There's one called Sohu. We all know Sohu. And so the point I'm trying to make is that as an investor, you don't know where the returns are going to come. You don't necessarily know ahead of time which of these 800 stocks, and there's about 800 on this list, are going to be interesting. In fact, if you say that a stock being up, say 20% isn't that exciting, say right here, and a stock being down 20% isn't that exciting, I wonder what amount are you actually excluding? So out of 800, you're excluding about half of these stocks. So half of these stocks in any given year will be interesting in that they could go down 20% or more, and the other half are interesting or not interesting in that they're going to stay within that 20% bound. You could actually measure this over the amount of years. Now, if you raise your barrier to say 30%, and you say, well, I really need to be able to make at least 30% in 1 year because I have some error margins, and you say the same thing on the short side, now you've got a little bit more. You sort of got 2/3 of them are eligible and not eligible. And sometimes you want the really big winners, the Weibos.com. I don't know how to say it. Weibo, W-E-I-B-O. The stock you could have bought a year ago for $10, and now it's $48. I don't know anything about this company. It looks like a social media platform in China. But the point is, this is the kind of stock you could have made quite a huge return on if you were there early. And some of these shorts, I don't know, let's see, Hortonworks, I don't know what this company does. It's an enterprise data platform, and you can see their stock has been in the toilet. It was $25 about a year ago, and now it's about $7. These are the kind of stocks that you want in your portfolio, long and short, hopefully in the right direction. So the point I'm trying to make, which I'll finally get to, is that it's really hard to know ahead of time how to whittle this list down. Because if you knew ahead of time what the middle 400 stocks were, you could just focus on the 200 best and the 200 worst. But the reality is there's no way to a priori or prospectively determine which of those stocks are going to have big moves. Maybe you think there's a way, but I don't think there's a way. And so the only solution is to actually look at all of them. And if you're looking at 800 stocks, you won't have the time to look at 800 stocks, I guarantee you that. But if you exclude China in this list and so forth, you might get it down to a reasonable number. And then I think it makes sense to actually go down the list one by one by one by one, because ultimately you will determine which ones are the best candidates for being long and short. And if you had the time to look at all of them, you would actually, I think, have a pretty good hit rate. Presumably, if you're a good investor and you are given a list of 400 stocks and someone freezes time and says you have all the time in the world to go work on these companies, and you are given a Weibo Corp and you short it, presumably there's something wrong with your framework, that your investing sort of framework is broken. But assuming your investment framework is a good one, and that you actually do know how to do your job, and that you do sort of know how to invest, time is actually your biggest enemy, in that you hopefully have all the time in the world with you and your team to look at all stocks, but it gets rather difficult as the number goes up. So typically what I like to do is focus on one universe of stocks that I can sort of think that I can get my arms around. Let's say like United States software companies or non-Chinese software companies. Here would be probably about 400 companies, especially if I include market caps above, say, 100 million at the start of the year. A lot of these are 100 million after going up quite a bit. It could be as little as 200 companies. And again, there's no way to tell which one is going to have a boring year like these. Could you imagine spending all your time on GoDaddy and then for years and years and years, the stock price never changes? That would be a painful waste of time and money. But sometimes it takes time for stocks to go up or down. So GoDaddy could be flat or 0% for a year or 2 years, and then all of a sudden it triples. And that happens from time to time. You can see that Google has only changed 1% over the last year. A company called Splunk. All of these well-known software companies. So anyway, that's sort of why I like to segment I want to ask myself, what am I going to look at? What pie am I trying to tackle? Because I think what happens to a lot of people is they don't think about the enormity of the task at hand. They think that by going through a couple of stocks and sort of feeling good about one of them or something like that they can actually make decisions, which is, I think, pretty silly if you think about it. It's sort of like going to a restaurant with 800 things on the menu and tasting one thing and saying, this is definitely the best, thing on the menu. And a wiser person would say, well, I like the way this tastes, but I'm really not sure because I haven't tasted the other 799. And you might be able to tell what a really good dish is versus a really, let's say, a rotten dish or something. But you just don't know how good or how rotten the rest of the menu is. And I think it makes a lot of sense to actually try to get a good framework and understanding of the entire amount. So let's go to the Angie's List, and let's take a look. So Angie's List is a small cap company. It was $8 or so when we last looked at it. Now it's $9 or so. Oops. And it's a $600 or $700 million company, so it's one of the smallest software companies we've ever looked at. And I like small cap stocks because larger investors like the Bridgewaters can't, Bridgewater we know doesn't trade equities, but if we pick, let's say, a Citadel or something, they can't spend a lot of time on these smaller companies. So the amount of competition you have is lower, and therefore the amount of investors that may be competing with you to determine if they're undervalued or overvalued is smaller. So Angie's List is part of this internet list of companies that we've looked at. We sort of segmented software into internet and enterprise, that it is a bit silly. I've been brushing up on my programming. The internet at the end of the day is really just an operating system. It's just a weaker operating system. We can think of things like Angie's List as consumer software, and we can think of things like SAP and Oracle as enterprise software. But you can even think of Salesforce.com as enterprise software, even though it's on the web. So this idea that the internet is a sector is kind of nonsensical. But let's sort of leave it at that. In fact, actually, let's change it. Let's change it to consumer software, consumer-facing software, or just consumer software, and we'll call the other one enterprise software, which is a very established name. Enterprise software. So Facebook is not enterprise software. It doesn't help a business or an enterprise do its job better. Neither is Angie's List. It's consumer-facing. Same thing with alarm.com and so forth. And we'll edit these as we as we look, I can even tell a couple right now. So I made a list of some enterprise software companies, did this very quickly, and then I have our old list of consumer software companies, of which we've made models for, I'd say, most of them. Although I don't pretend to say that this list is complete. So without further ado, let's open up our, wrong model, our Angie's List model. And I couldn't make a lot of sense of Angie's List, was my conclusion. I thought that the current stock price was about right. I had in this refresh in the model about a 21% discount. I think the problem I had with Angie's List is that they're very unprofitable. They haven't had positive free cash flow in a while. Their business model is a little bit broken. And if you look at free cash flow, they've averaged negative free cash flow for quite a long time, and I didn't envision that changing. But let's kind of go through the model a little bit more detail. So as usual, I just go through the SEC's website and type in the stock ticker, which is ANGI, and they actually have reported Q2, so I can actually plug in those numbers and see if they've been sort of in the midst of a turnaround, or all turnarounds are sort of hopeful. You never know if they'll actually work. Although, what's interesting is that the company has had revenue growth. They just haven't had it in a while. You can see in 2012, the company was doing 30 or 40 million in revenue per quarter. That went up to 50 to 60, that went up to 70 to 80, and it's kind of been pretty stagnant at 70 to 80 for a while, averaging about 82 million for the last 12 quarters. And you can see here, let's see, we can add this up real quick. You can see here quite robust revenue growth, but starting to slow down, and 2016 looks like it'll be a down year, which is kind of the death knell for a growth company. Once you have your first down year over year, you're definitely a mature business. And they've guided to, I think, a flat year, so we'll see if Q2 is promising at all. You can see the paid membership has grown from 1 million users to about 3 million users, so 3 million people have Angie's List. And you can see when you have 3 million users and 3 billion or 300 million in revenue, each customer is giving you about $100 $100 per user. So 3 million people, $100 each, 300 million, and you can see that they, despite that, are not profitable. They need more than $100 per user. You can see that their membership revenue is actually $20 per user, and they actually get a bunch of service revenue from their service providers. So they make far more money on their service providers, and I think that they actually have decided to move towards the free membership. Hi, Mike Flanagan is here, and we'll talk about that in a minute. So in Q2, we can see how they navigate that free membership. Obviously, they'll get a lot more members, and their service revenue will go up, but obviously their high margin membership revenue will disappear in essence. So let's see here. They reported Q2, they have 15.645 in membership revenue, 67.415 in service revenue, a total of 83 million. Again, average, and in fact, down year over year, down about 5% over last year. Again, for a growth company is not where you want to be. For any company, it's not where you want to be. You want to always be growing. But in this case, they are not. I think I caught my cough from Hillary. All right, operations and support, 10.172. Selling, 26,983. Marketing, 13,432. Product and technology, G&A. Some more disclosure than most companies give you. And you can see that they are actually able to turn at least GAAP profit of 6 million in operating income. So their cost is definitely, you see revenue's down year over year, but costs are down way more year over year, and that's pretty promising. So I guess they have some debt because they're paying some interest expense. So let's take that out. So they're down about 5 million in I guess after interest income, pre-tax income. They don't pay taxes, or at least didn't this quarter. So a nice 5 million net income quarter. And you can see that you get these here and there with Angie's. They're kind of lumpy, pretty lumpy business. So they had a very nice quarter, and that's probably why the stock's up a little bit from last time we looked at it. But as we know, Angie's List has kind of a funky cash flow. So let's take a look at their cash flow statement. And we have a bunch of add backs we have to do. So according to this, let's do the balance sheet first. Why not? Start with that and then move on. So 180 million in assets. You can see deferred membership revenue declining, which I think they have told us. Deferred advertising revenue is not increasing. We still have that debt. It's about cash neutral. Well, it's actually not declining because I didn't include the long term. All right, other liabilities. And the balance sheet does balance. And their cash didn't grow despite $5 million in supposed net income. Their net cash actually dropped. So the cash flow statement will actually tell us a little bit more about that. So reported net income for 6 months was a total of $800,000, and that makes sense because last quarter was a loss of $4 million. So for this quarter, our model net income and our reported net income match up exactly. D&A is a huge contributor here. Amortization of debt. And here is sort of the problem with Angie's List, is stock-based compensation. We'll talk about that in a second. But they had another $3 or $4 million of stock-based compensation this quarter, which is really a drain on what I think is true cash flow from operations. All right, so we have a disposal charge here, and we've got accounts receivable. We have sort of changes in assets and liabilities, so we can add these all up super fast. Right, and these two should add up to 14.286, and they do. So in the last 6 months, Angie's List has generated positive operating cash flow of $14 million. There's a couple of problems with this, though. First, you have CapEx. So let's just do this investments thing. CapEx doesn't come from the cash flow from operations, it comes from cash flow from investing. And you may call it investing, but I call it expenses when it comes to a company like Angie's List. These aren't really investments. And we'll see why that's the case in a second. So we have property, equipment, and software, and capitalized website and software development costs. So you can see that even though cash flow from operations totals $14 million for 2 quarters, if you include the CapEx, because we are including the add back for D&A, we've went over this a million times in other lessons, you really are only getting $2 million for 6 months. Now if you annualize that, you get $4 million. So you get a really close to basically a break-even company. I would not pay $600 million for a company that is making $4 million a year. That just doesn't make a lot of sense. It'd take you 100 years to get your money back. So I think that's very suspicious. And then finally, remember, we're adding back stock-based compensation. But stock-based compensation was $6.7 million. So we take that 2.1, subtract 6.7 million. Let's do that here. 2.1 minus 6.7. They're actually losing 4.6 million over 6 months, which means that they're losing $9 million over the full year. Would you pay $650 million for something that's losing $9 million a year? No thanks. I'm not interested in paying $650 million for that. Now, what's interesting here is that as a small shareholder, as an individual investor, or maybe even a small hedge fund, right? You're not going to make a $650 million investment in Angie's List. But let's say you were considering making a $6 million investment, or even a $600,000 investment, or a $60,000 investment, or whatever it might be. You still have to act as if you're analyzing the company in its totality. And so you might say, okay, well, $650 million for a company that's losing $9 million a year. How about, would I pay $6 million for something that's losing $900,000 a year? It's a similar, or $90,000 a year. It's a similar calculation. And the general answer is you wouldn't pay anything for something that's going to continue to lose money forever. Needless to say, that's not a valuable asset. But obviously the hope is that somehow they can turn around their business and they can start making money sooner or later. And we can think about how that happens. I buy companies all the time that lose money right now, but they are sort of giving me some kind of promise that they're going to make money in the future. That happens every day in capitalism and in investing. All right, so negative 12.3. Then they have this sort of cash flow from financing, which isn't too important. And so we can add these up, and we can see again that the trailing 12 months free cash flow plus stock-based compensation is a really nasty number, negative $22 million. So even worse than our annualizing the last 2 quarters. So this business is in really bad shape. Revenue is dropping. Even though GAAP costs are dropping, it doesn't look like GAAP net income, non-GAAP net income is improving. So we really have a long ways to go for Angie's List. I think the stock, if I had to bet, would be a short, especially as in a high change environment like the one we're in, where internet technologies are rapidly being changed. Let's see if they gave out any numbers with respect to membership. Membership is an important leading indicator of success. So we see here, Angie's List reports Q2. You can tag in along. Yeah. Since dropping the reviews paywall, we added 700,000 customers. All right, well, that's pretty impressive. Let's see here, paid membership. So I guess they're gonna have a depends on when they dropped it, right? That's the question. And definitely more people are using the website. The question is, can they convert that and monetize that? And typically when you go to a business and you say, hey, we had 3 million people viewing this product, your products, now it's 4 million people, you should pay us 30% more. I think that sounds reasonable. Now the problem is, as a percentage of revenue, membership revenue is 20% of revenue. So they definitely have to make that up. Their number of subscribers has gone up way more than 20%. According to this, it's gone up, actually, if they say it's only gone up 700,000, that's only about, that is only about 20%. Yeah, so I'm not so sure. Maybe they dropped their marketing costs? I don't know, they still have to tell people that the website exists. Alright, so let's say their selling and marketing costs drop because of this. The paid business can go away. So let's say this drops. Now I think they're still selling and marketing to their service providers. So maybe let's model a permanent 20% drop in these costs. I don't know. You get a little bit of upside. The big promise on Angie's List is that these older cohorts, that these older cities, they were in 10 markets and they're doing $100 per in service revenue per member, and in the newer markets they're only doing $40. And the promise is that they're going to grow that substantially. Now they haven't been able to do that, and that might be because the new markets are just not that exciting. I mean, I definitely don't get any excitement looking at this. But let's look at some other people's models. So this is our model. Let's look at, this is Rachel's model. All right. Let's see if this is any good. She points out this pricing. You can buy a 3-year subscription. That's a little annoying if it's free now. They're not going to give their money back. You can buy Plus or Platinum, and you get all this stuff. They had an offer from Interactive. I didn't know that. They got a new CEO in 2015 who's president of Expedia. All right. This is interesting. Consumer Affairs. This is a good model, Rachel, so far. Consumer Affairs has a lot of complaints where people use Angie's List and doesn't get any results. That's not good. I believe in Durschlag's ability to impel. I don't know if that's the right word, impel. Short-term growth based on his impressive track record. Okay. Yeah, and this company kind of fits in this sort of like peer group with Yelp and Groupon. It's sort of this like crowdsourced, crowd shopping kind of space that's like a very interesting little space. Competitors, Amazon Home Services. Really? That doesn't sound right. Get points off for that.
You like getting things done? I like getting things done. I buy everything on Amazon because it's quick and convenient. And now, Amazon's introducing a new way to shop for services with confidence. I can easily purchase hundreds of services. Things like TV installation, landscaping, and music lessons.
So cool, the guys come out of nowhere. It's funny.
Handpicked pros go through thorough background checks. Reviews are from verified customers, not robots. And the best part? Amazon's happiness guaranteed. That way, if something does go wrong, I know Amazon will take care of me, just like they always have. So in just a few clicks, I can save the day. Do a little something for myself. And call in an expert.
Okay, so it is a competitor. Let me take a look here. See how this works. It looks pretty crappy. All right, what do I need? Fitness instructor. There we go. There's two people in Manhattan, so looks like Amazon Home Services is a long way to go. Try one more. Plumber. A little more reasonable. Okay, there's a lot more for plumber. Yeah, so again, I think the idea that like this list is somehow proprietary or that they do a really good job of managing it is a little silly. What's Thumbtack? You're saying Thumbtack is a competitor? Consumers checkbox. Let's see. Nonprofit ratings and reviews of local service companies and healthcare providers. So this is a A non-profit, is that fair? Non-profit and unbiased. There you go. Yeah, I guess that's one of the fears, right? If you're a great service provider, you're on Angie's List, versus you're not such a great service provider, but you're paying Angie's List. I think that's a little bit problematic. Home Advisor, Better Business Bureau, Porch.com, and of course Yelp. Let's see about this Thumbtack, is it? Thumbtack.com. Yeah, so a lot of competitors. That doesn't normally scare me. I mean, again, they're starting to grow again. After 20 years, it's now free to join. Looks like they're still selling it. It's just that there's sort of a freemium thing. All right, so Rachel did a good job of describing the business. Let's see how her model fared. Looks pretty good, same as mine. She has the company growing pretty dramatically. Something's off here. Oh, I see. The high discount rate mollifies the high net income. Yeah, I'd be surprised if they reach this margin structure given the currently low margin structure, and there doesn't seem to be a call out of the free cash flow problem that they have. So I give this model like maybe a B+. Let's look a little further. Gee, you have memberships dropping. Wait a second. Oh, I see, but service provider growing. That makes sense. Yeah, this is pretty good. Definitely a good model. Let's look at a few more. This is Robert. Kind of a weak front page here. I don't like this notes nonsense. Charts. This is kind of neat. Let's take a look. Angie's List. I guess Home Advisor is kind of creeping. Yelp and Groupon have a lot more attention paid to them than those companies. Okay. This is really sloppy. It doesn't lend itself to TaskRabbit is a competitor. They're struggling, I think. Thumbtack raises a lot of money. Wow. All right, this is pretty sloppy from a information perspective. Let's take a look at the forecasts. Again, a little, quite a sanguine outlook. High discount rate, so I get that. But to me, I'd rather try to forecast what I really think is going to happen. And then the discount rate is not a good way to kind of take a hammer to a model. There's no attention at all to cash flow here, which is really, really bad. I mean, I don't see a cash flow statement or a balance sheet, so I give this model probably a C or D. I wouldn't let you work for me. All right, Stanley, the Manly. Not bad. No cash flow statement, no balance sheet. This stuff never impressed me. Yeah, the more revenue they have and the lower the discount rate, yeah, I get it, the stock will go up. So this is a more realistic kind of margin structure, although I don't see them companies don't just like decline, their growth doesn't decline and then just pick right back up. That typically is not how these types of businesses work. So all these models so far, if the company's down 5% year over year and all of a sudden they're going to double their revenue, I think that's a little foolish. I don't quite buy that. All right, Harris, bad boy, aka the great one. It's hilarious. Harris's models are always great. So this guy, are you saying he used to be extremely fat? I hope bad boy's here. That's not nice. And then he became trim. All right. And then, oh wow. Looks really handsome now. And the watch. Oh my god, you even looked up the watch. This is why Bad Boy is going to be like the greatest investor of all time. It's a $20,000 watch. And apparently the Dalai Lama wears the same watch. Bad Boy's only like 17. He's great. Well, the guy worked at Best Buy, which was not, Best Buy had a couple of crappy years there. And Expedia, Motorola, that's a bunch of shitty brands. Did you write "led a fucking turnaround"? That's pretty funny. I don't know. I don't know if you're kidding or what, but I don't believe in the CEO. Thumbtack, City Search, Merchant Circle, Facebook. Oh, Facebook services. What's that? There you go. Facebook's in the business now too. Again, competitors don't scare me because ultimately it means that you're doing something right when everyone in the world wants to come crush you. It's arguably a good thing more than it usually is a bad thing. He's got some CEO interviews.
Well, I really believe Angie's List is at the frontier of e-commerce right now. And really, think about it. It all started with Internet 1.0 information, Internet 2.0 transactions, e-commerce, the rise of Amazon, Internet 3.0 social, mobile, Facebook. All about relationships. Internet 4.0 is all about the power of place. And Angie's List has been all about that for the last 20 years. Local services is the essence of the power of place.
Okay, so one of the things in my management, one of the things that's really important is in investing is management. And experience is kind of the best way to judge management. This guy's like a born salesperson, but I'm very skeptical. I'm just looking at him for 5 minutes, or for 1 minute, I get a very bad feeling. Sometimes intuition in business does have its place, but you have to be, reserved.
You're talking about, you mentioned the word local. That talk of Google and Amazon coming in and dominating the space doesn't concern you?
No, not at all. I've been competing against Amazon at Best Buy and against Google at Expedia. No, those are all about big scale, one size fits all solution.
All right. Well, here's a model from Averill. Kind of hard to read. He also did the Google Trends thing. Energy List hasn't disappeared in popularity. It's sort of like the Yellow Pages, right? It's like a Yellow Pages with better connectivity. Poor Glassdoor reviews, seems to constantly overspend on marketing. Unprofitable even though in business for 20 years, that makes sense. These are good insights. Again, no cash flow statement really misunderstands this company because they look better than they do without cash flow. Although you did get to the right number, partially it's because you don't assume great revenue growth. But your model is a little funky here. You could use a little formatting magic. And yeah, not exactly sure what you're doing here. Yeah, this is a no-no, not a good way to forecast. Just assuming they get to 20% scale isn't, I think, reasonable. All right, back to Harris's model. Yeah, I mean, it's a bet on the CEO, but I don't know that he's been that successful, to be honest. And you have paid memberships doing what exactly? I'm assuming these are not paid. Yeah, there's something up with your model, bad boy. It's definitely broken. Yeah, NPV of 1.3 billion. Yeah, this model is bad. Good find on the Rolex. Finn. Again, no cash flow, no go. You're fired. Richard. 1/4 of cash flow, that's all you give me? Fired. Alright, let's see here. Andrew. Cringe inducing. Yeah, not a good income statement or cash flow, or total lack of cash flow. Flanagan is normally the best. That's Mike Flanagan. What is this? App Annie? Never heard of it. It's kind of neat. Huh. Interesting. Very unfavorable reviews. We've seen that before. These are kind of neat. App Annie. I like that. Okay. Alexa rankings. Put Yelp and Groupon much higher. Maybe that'll change after the paywall. All right, let's look at the model. You mentioned you were a little too excited about revenue growth, and Q2 definitely means they're tracking below, I think. Thing about cash flow, thing about free cash flow statements is you have to, which you didn't do, is you have to normalize them with the income statement, and that's not always easy to do. But if net income from the income statement and free cash flow are off, they should converge over time, but it really depends on what they're reporting. They should be reporting according to GAAP, but we have to think about that. So this model is just kind of, I think, poorly built, given you have membership revenue continuing to grow, which I would imagine it's gonna sink. Can't have it both ways. Margins improving really dramatically because they're not profitable now, and I think that's the secret, is that GAAP net income is positive, but free cash flow is still negative. So I give you a B, and that's because I'm not being nice to you. Adnan. Yeah, this was impossible to read and no cash flow statement, so I'm not even going to look at it. Give you an F. You're fired. Steven. No cash flow statement on a quarterly basis at least. You know, the company doubling in revenue growth despite having losing their biggest source, which is membership revenue, is going to disappear. I don't know, this is just poor forecasting, poor judgment. You're fired. Ah, Goji. Again, with the revenue growth, nobody had the guts to say this business isn't growing, it's shrinking. Massive margin improvement. At least you have membership revenue declining a little bit. I don't know why you had to split out operating metrics. I'll spare you from being fired. TKC. That high cost of failure concept. It's pretty interesting. No cash flow or balance sheet. You're fired. Alright, last one. This is from Chris. This is good. A lot of good notes here. No cash flow statement. You can't really look at a company without looking at all three: balance sheet, income statement, cash flow statement. So you're fired. Okay. Looks like we are done. So that's it for Angie's list. I'd probably short it. So we'll show you the portfolio. We're doing pretty well. We are long Microsoft, RealPage, and Stamps.com and Facebook. And we're short Netflix and Apple. And we're making money on almost all of our positions. So we're up a total of $4,000. So we should continue to deploy our capital. We haven't done much, but I think we can short Angie's list pretty comfortably. So I'll do that tomorrow, and we'll see how that goes over the long run. We've got our investment management team here. Okay. Yeah, Stamps has been crazy volatile, but volatility doesn't bother me. Just buy the stock and forget about it, or short the stock and forget about it. Especially with the amount of money we're talking about. Okay. So I was thinking we can. I don't trade options, so just common stock. So I was thinking we could look at a software stock. And one of the ways we can do that is quickly look at market cap adjusted. And if anything points out to you, stands out to you guys, just let me know. I think we should do an enterprise one, but I'm also open-minded to doing more of the consumer-facing ones. Capgemini doesn't really count. Wipro doesn't really count. These aren't really software companies. They're more consulting companies. Red Hat, ServiceNow. I don't know that one. Sounds interesting. How about Weibo or Weibo Corp? Akamai, Amdocs, these are all old school software companies. Cadence is what, design software? PayPal. Software? Is it a payment processor? What is it? Should we do Oracle? How about Salesforce.com? It's a very popular company. Stock ticker is CRM. One of the biggest software companies in the world. 50 billion market cap. We'll do it from scratch as well, because I don't think we have a Salesforce.com model. Nope. just put one together real fast. So last time we looked at it, stock is $71. It's still in that ballpark. So let's just make a model real quick and learn a little bit more about it. I think we all know it's a customer relationship management software, but I think they do quite a bit more than that now. So let's take a look, and of course I'll upload these files after we're done. I use one of Salesforce's products called Heroku. I don't think it's a big revenue generator for them, but sort of a mind share generator. Shut up, kitty. Shut up. I said shut up. All right, so number of shares outstanding, 685. $50 billion enterprise value or market cap. Let's see what the enterprise value is in a second. Shut up, kitty. Cat has joined me, my junior analyst here. All right, so $2 billion in cash. There's a convertible note. There's a term loan. You want to trade the term loan, kitty? You can't. So roughly the same amount of cash and debt. The cat's down here if you want to see the cat. Shut up. Let's see. There's a loan on a building probably. Shut up. All right, looks like the balance sheet, we got most of that. Let's see, subscription and services. IFRS. I unfortunately have painfully learned both IFRS and GAAP. All right, it's a lot of revenue. So yeah, a long time ago, Salesforce went on its mission to compete with Oracle in CRM software. There's two companies called Siebel and PeopleSoft that made CRM software for the enterprise, and it was the old school clunky enterprise software. And then finally, web services was the old name. Now it's software as a service, or whatever you want to call it, is sort of taken over. We got $2 billion in quarterly revenue. A year ago, that was $1.6 billion, so pretty rapid growth has characterized the company. Let's take a look at what percentage that is, about 25% I want to say. Yeah, 25% revenue growth. All right, like most software, I would imagine that it's an enormous margin. I'm just going to loop together the entire gross margin line. 75% gross margin. If you just did the we used to call it license revenue, but now we call it subscription revenue. This includes the services margin, which is very low. You can see the services, they actually lose money in the services, so subscription is closer to 80% margins. All right, so now they have marketing and sales. To sell this kind of software, you need a Salesforce. It's interesting. According to GAAP, they're basically break even. Let's see what cash flow statement tells us. That is surprising. And we'll talk about how to look at companies at scale as well. Alright, so they include stock-based comp, which makes a lot of sense. We have to think about how to look at that in a minute. You can see cash flow from operations is $250. Let's just jot that down real quick. See, I'm a little bit at a loss here because it says net income $229. And they don't bridge that, or maybe they do. Oh, including this benefit from income taxes, which is a valuation allowance already. So $250 million in cash flow from operations. Let's just quickly do CapEx and SBC. So CapEx. There it is, 96 million. And then SBC, stock-based comp, 182 million. All right, so Salesforce.com is a $50 billion unprofitable company. Pretty amazing. I think this has been a problem, not a problem, but a feature, if you'll call it that, of Salesforce for a long time. But again, you have to think about oh, you can't use the bad words in this chat. Sorry. No racist words, please. So anyway, what do you do when you have a company that's like this? You know, they're growing like weed, but they have no cash flow. You can still value it actually relatively easily because you have to think about scale and is this the R&D structure? Is this the cost structure that they're going to always have necessarily? And the spoiler, of course, is that no, they probably will scale differently. And what does that look like is a question. And we've seen that with companies like Amazon.com. You sort of have to use your imagination a little bit. But what you're actually doing, it's you might say, well, that sounds very hand wavy. I don't want to use my imagination. I want to see cash flow. Well, it doesn't really work that way because at the end of the day, the way companies like this work is they're reinvesting into these projects, and these projects may or may not bear fruit, but they're probably smart investments given the growth the company's seen. So we'll talk more and more about this as we plug and chug, but hang on just 2 seconds. I'll show you how we kind of manipulate these numbers to the point that we try to reflect reality as especially a future reality that could be a more scaled company. Yeah, an acquisition is still a project of sorts, right? They do have that sort of, someone called it delusional. I don't know if I'd call it delusional, but they have that sort of dreamer management team where they definitely want to take over the world. Okay. Let's go to their website. Well, they have a lot of growth. So it reminds a lot of people of, Amazon.com and things like that. 25% revenue growth is not easy to come by. Let's look at some. They have a weird quarterly, strange quarterly system here. There it is. Q1, Q2. Let's take a look at. This is Q4. So let me try to put the dates in here. Q4 is 1/31/16. Not many companies are growing at this rate, especially with this scale. I mean, this is a lot of revenue. So just consider that for a moment. The only question is, why are the margins so bad? Software companies usually have much, much higher margins than this. And we can get to the bottom of that, and we will in just a moment. Okay, you see the revenue growth has been quite sustained. Let's make sure we got these funky quarters right. All right, 3 months for, what is this, April 30th. Yep. Okay, now the last one is Q2. And now this is Q2 17, so we should probably redo this. All right, cool. Let's look at the, what are we looking at? This. 10/31/15. Okay. You can see the unbelievable trend where they had almost $100 million in quarterly revenue. 1.4, 1.5, 1.6, 1.7, 1.8, 1.9, 2.0. Really metronomic almost. The cool thing about subscription companies is that their software, their revenue is very predictable. Because if you're signing up for subscription revenue for many years, what your revenue will be the next several quarters. And we're going to talk about that dynamic and how it works with accounting in a minute. There's something called deferred revenue that we have to look at very closely for software companies. Tax line is so strange, but not uncommon for a company like this to have a bizarro tax line. All right, we're almost done with our quarterly financials, at least for the income statement, and then we got to sort of take a look at these cash flow statements, because you get a lot of funky things going on here with this company. Really complicated company from an accounting perspective to understand, and I would encourage you, if you really want to take on a complicated challenge, so you have things like gain on sales of land and building improvements, which is a little bit laughable, but according to GAAP has to be included. Hard to think of that as a recurring cost. All right, so 25% revenue growth has been very constant. We'll look at guidance. We'll look at cash flow. Where should we start? How about the most recent quarter? So let's take a look at the earnings release and read through it together. They have some currency translation, which makes sense. Deferred revenue, as I mentioned, is going to be something we want to track really closely, including unbilled deferred revenue, since these are leading indicators of revenue. They give us third quarter guidance of 2.11 to 2.12, and you can bet that that guidance will be accurate, given that 99% of the revenue is already scheduled to be received or is contractually obligated. So that'll be another 25% quarter, 25% growth quarter, as DJ Khaled would say, another one. Let's see if SG&A is growing 25% year over year. SG&A is their biggest expense. Doesn't seem, or not SG&A, but marketing and sales. Yeah, it's only growing 15% a year, which is great, right? When you have revenue growing faster than your biggest cost, that's kind of what you're looking for in life. You might also be looking for things like love, but in general, that's what I'm looking for in life. Faster revenue growth than operating expenses. So I'm just going to put in like a 15% tax rate, and we'll start to normalize basically what this company will look like. Leap year. Okay, so what's going to happen to R&D for this company? That's sort of the question. Let's see how R&D is growing. Inevitably, R&D kind of has to slow down. And is R&D really related to the current business, or is it related to the legacy business? Related to new business. And so if you wanted to think about that, which I think you should think about really hard, my guess is that R&D is not a real cost here. Now, it's not going to save you much money, since it's a pretty small percentage of revenue. And the G&A is already leveraged in their scale. They have a pretty big scale. So this marketing and sales is the problem, and their cost there is pretty enormous. So it's remarkable that they're not more profitable. It's an $8 billion software company that's unprofitable. Haven't really seen that ever. I'd be curious to go back to Microsoft and Oracle's days and kind of see what kind of profit margins they had at that level. They might be kind of over costing or overspending, I should say, but something seems a little off here. So let's say they grow for 20% rate for a few more years, then I don't know, a 10% rate for a few more years, and then that's it. And I guess they can improve their margins a little bit. Let's keep it at 77. And then marketing and sales expense should slow down. There could be some stock option expense normalization there. We're going to haircut R&D, and we'll think about that as a normalized kind of running the current business R&D. And this guy, I'm assuming they're sort of at full scale for G&A. So on a fully scaled out model, they could be earning this makes a little bit. This is why they have a $50 billion valuation, because it would not take much other than spending discipline to reach this kind of reality. Now, I don't know what kind of tax planning they have. I'm assuming they'll pay a normal tax rate of say 25%. Let's do a little bit more math here. All right, moment of truth. $66 billion. All right, that is, for a first guess, is awfully close to the current share price. Yeah, so 85, the model says $85 a share, the stock's at $74 a share. Market is very efficient. So the market is basically telling you that it thinks on 8% cost of capital, the company will go from roughly doing $8 billion in revenue a year now to $16 billion in 4 or 5 years, and then sort of stagnant at $20 billion, improve its margins dramatically, and that's sort of what the market's sort of telling you to do. 25% tax rate is pretty normal for a company like this. You can look at what the other companies pay. Let's take a look. Microsoft's tax rate is about 20%, 19% looks like. Oracle tax rate 20%. That's pretty normal. 25 is maybe a little aggressive, but we'll leave it at that. And I truly think, let's take a look here. Let's operating margin. They have no operating margin right now, so it sort of doesn't really matter. see what we have it going from break even to really dramatic. Yeah, maybe too dramatic. Too dramatic. But you know, that's the question: is how and when can they pour on the margin? We are all assuming that they can, but maybe they can't. You know, you never know with these things. I'm also haircutting R&D. Remember to correct for sort of a missing scale. I don't know. I stand by it. It's also, what's interesting is even if it's a little aggressive, what's kind of cool is that it's what the market is telling you is going to happen. Right? So by any combination, whether it be revenue, discount, and margins, you should be able to solve for and impute what the market is expecting. You can go watch the YouTube if you want to continue this Periscope, but I have to close the Periscope. So even if these estimates are, let's say they're ludicrous, and there's no way they can go from basically breaking even to a 40% operating margin, what's important is that the market's telling you that they can. And so if that is ludicrous, a short sale would be extremely profitable. So let's take a look at the cash flow statement a little bit more. Cash flow and net income converge eventually, obviously. Yeah, the autonomy acquisition was a fraudulent issue, I think. Fraudulent accounting, which in software, unfortunately, is very common. We're going to look at a company called CA, where some of the people behind that company ended up going to jail for accounting fraud. Let's see, deferred commissions. Software accounting is amongst the most complicated, and one day we'll try to tackle it. Call it revenue recognition. That's the big problem with software. Deferred commissions, non-current deferred commissions. Capitalized software. Goodwill. Capitalized software is probably good, just basically intangibles. Strategic investments are going to add as cash. Other assets. We'll add. Okay. Now let's look at accounts payable. 67, 96. Now, deferred revenue, we have to be very careful on, since this is truly important. Like I said, the thing about deferred revenue is it's a leading indicator for revenue. So we're going to have to monitor deferred revenue very carefully. And I think their deferred revenue is growing at 30% a year, which means that revenue is going to grow 30% a year, which is really promising. So you could actually have faster revenue growth than maybe we're thinking, including here. A couple more quarters of 25% revenue growth definitely boosts the NPV now to over $100 a share, and it's at 74 right now. All right, let's keep looking here. They have these debt instruments. First a convertible, and then a term loan, and then this Fremont Avenue loan. added that other deferred revenue. All right, so the balance sheet balances quite nicely. Now we're going to do the cash flow. So we're going to say model net income and reported net income. And these two are very different because we're not playing their kind of game with the taxes. So our model net income is only 24 million. Their model net income, or their GAAP net income, is positive 229 million, mostly due to a tax adjustment. And so here are the other add backs. We have D&A. We've got amortization of debt discount, which is an accounting concept, amortization of deferred commissions, and of course stock-based comp, which is a really tricky one because even though stock-based comp is non-cash, it is an expense, and adding it back is not something that I believe in. And of course all of the working capital changes on the balance sheet. All right, so if we add all of this up, we get 250.678, which matches with their cash flow from operations, working capital, amort of commissions. Let's see, amort of debt and D&A. All right, now let's go to the acquisitions. So big acquisition. I wonder who they bought. $3 billion. They're always buying someone. Ciao, kitty. Exact target? Yeah, I don't know. It was cute. It was the most recent quarter, so. All right, so with just this, we can actually do quite a bit of analysis. But let's do one more quarter. See, the total change in cash was negative 800 million, which is very telling for a company that's a 50 billion enterprise value. It's a really enormous quarterly loss. But again, I think, well, let's do some more math. Let's do cash flow from operations plus stock-based comp minus minus capex. Let's see what that looks like. So this is like true cash operating performance. Since stock-based comp for a company like this is close to true cash flow. And we can see they break even roughly, negative 28 million. Interesting. Now again, they do a little bit of extra R&D, and they have quite a robust growth trajectory, but it makes you wonder if your margin assumptions are really realistic, getting to 40% operating margins. But let's take a look at their cash position is very close to zero. Acquisitions isn't a part of CapEx because it's not part of CapEx. It's not a property, plant, or equipment. It's interesting, deferred revenue dropped. That might be a seasonal thing, but it definitely is not the sign of a growth company to have deferred revenue drop. If you see that very carefully, quarter over quarter, deferred revenue did drop. I went over deferred revenue a number of lessons ago on how to look at it and think about it. So they just took the term loan out, which we saw in the quarter. Other liabilities. Okay, balance sheet balances. You can see both the assets and the liabilities plus shareholders' equity is the same. But now let's go back to the cash flow statement. We'll see if Q1 was any different. This should be exciting. All right, now for this quarter, you see the model net income and reported net income are pretty close. We add back D&A, of course. We're going to add back the various amorts. There's a gain on sale. And then amort of commissions and stock-based comp. Collect all their receivables, looks like. These things ebb and flow. And we may find out, interestingly, that you can't judge a book by one quarter. So you can see here that the combined cash flow is much, much higher. Much, much higher when you look at 2 quarters. So this might have just been, you can see here in the working capital, they collected a lot here. So a lot of their accounts, you can see here, the accounts receivable specifically, they collected a ton of receivables. And in this quarter, they kind of extended those receivables, which is why we can't judge these things on one quarter. So I'm a lot more comfortable now with my margins going to 40% assumption. We'll see what the margins look like in a second. Here's CapEx. Aha. You get cash when the employees exercise their stock options. All right, so if we look at cash flow from operations plus stock-based comp minus CapEx, we get, well, we should actually, can anyone find the mistake here? There's a crucial mistake. Pretty sure. Yes. It's a crucial mistake I made. I'm trying to, as usual, it's not a huge mistake, but if you can point it out, I'd be very impressed. What's wrong with this line? Shouldn't add back D&A, get out of here. It's added back already. No Rolex? No. So it's a very interesting line item. We can debate it as to whether or not it's a mistake. See if anyone can find it. Of course, whenever you're modeling, you're trying to find the true operating cash of the company. That's why I'm doing cash flow from operations. Ah, very good, Alex. It's missing the cash from ESOP. Now, what do you think? Is that reasonable to add? Is that reasonable to add? Because they're stock options that are exercised a long time ago, right? There's no bearing to today's stock options, really. And presumably, this expense is Black-Scholes calculated, it's fully calculated, and that expense is net of the cash received. So is it truly an operating? It's a really interesting question. I think you would look at both. I would look at both. It doesn't swing things enough to matter, but it's not nothing. So if you look at this, you've got $1 billion over 6 months, so maybe $2 billion a year in cash flow from operations. That's actually not bad at all. That's not bad at all. That's 25 times earnings for a really, really good growth company. And if you think about $1 billion in cash flow from operations over $4 billion in revenue over the same period, you're really talking about 25% net margins. So really not far from that right now. And the fact that deferred revenue is growing, that really is telling. So let's see if we can look at deferred revenue. That's an important line. Just as a reminder, deferred revenue is a leading indicator of revenue. Why it's booked as a liability is something that puzzles all first-year accounting students and financial students. But I'll let you guys worry about that. I'm a grown-ass man. All right. So now you see deferred revenue on this perennial decline. It's very worrisome. Very worrisome. 4.3, 4.0, 3.8. Why is that happening? Why is that happening? Do they have a good reason? Let's look at it here. I guess they're now telling us to look at this unbooked deferred revenue. Unbooked deferred revenue. So I don't like that. Not used to that. There's a huge jump in deferred revenue, so maybe a couple quarters doesn't tell the whole story. If you look at this, something funky here. I don't know. Wait a second. It's the same thing here. Deferred revenue, $3 billion. All right, so deferred revenue year over year is still up substantially, and it better bump up next quarter, right? All right, so watch that carefully, but I'm pretty attracted to this. I like the idea that their margins are already kind of where I expect, and the growth is a little better than I'm modeling, but I just like to be a little conservative. The discount rate is I think, appropriate. It's got quite a bit of upside, possibly. So this is the first kind of look at Salesforce. We have to do a lot more before we can really look at it. Does anyone have any questions? What for is cash flow from operations plus stock-based comp minus capex? What for? I don't know. I probably I'm attracted to it. I haven't decided. I don't really like to buy stocks or sell stocks after a quick look. I like to focus much more on them. So it'll be a while before I decide. But it looks pretty attractive. Employee stock-based compensation or employee stock ownership plans are pretty complicated, and you should spend some time thinking that through. You have a question, Kitty? Shut up. Shut up. I don't answer questions on individual stocks, and like I said, they don't really have a high PE because the non-GAAP income, net income difference is substantial. They basically have break even on net income, which distorts, or GAAP net income, which distorts the so-called price to earnings ratio. But if you actually do all these add backs, you get a more realistic viewpoint that they're actually earning closer to $2 billion or more in net income. So their actual quote-unquote PE or EV to cash flow is more like 20 times, which for a 30% grower is enormously inexpensive. 8% discount rate because we give Microsoft 6% discount rate. Oh, hey, kitty. Sorry. I just elbowed my cat. Hey, I didn't mean to do that. Cats are resilient, thankfully. You'll see, I want to look at the company software offerings and their positioning in the software market. I mean, I know a little bit about it myself, but we have to do some real fundamental analysis of what exactly it is they're doing. Come up here, kitty. I can teach this cat Excel, and I will. Ow! Why are you scratching me, kitty? She's trying to scratch her nails on this chair. What do I think about their acquisition spree? It's a great question. That's one of the things I'll be analyzing. I am banned from Twitch. Perma-banned. Shut up, kitty. Shut up. No more dog. No, Joe. No. You gotta use the mouse sometimes. Isn't Benioff a billionaire? Alright, everyone. Well, got about 2 minutes to go before I wrap up. 1 minute to go. So thanks for joining. Really appreciate your patronage. Good to see you all. Enjoy doing this. Let's see how many users were watching at peak. I don't know. Oh, 250 or so. That's nice. Well, thanks again. I hope you learned something, and we'll see you next week. Same time, same place. Bye, everyone.